All right, so let's go ahead and get started. First thing, I just want to say that all of the stuff that we're sharing in the Limitless group, it's all going to be available for free. So we're just going to put a little disclaimer. Obviously, we're not financial analysts. None of us are licensed to give any sort of recommendation for investing. What we're doing here is merely just explaining from our own personal experience what we do and trying to pass the message on to the next people. So all of this information is available for free on YouTube. You can see the pinned link on the channel. If you would just like, subscribe, all of that stuff. We're not really trying to build anything on YouTube, just want to have a place where people who are interested in smart money concepts, supply and demand, can go and they can learn start to finish. So we'll get started. The biggest thing that I want to talk about today, we're not really going to get into entries or anything like that. We may mark up some zones. Primarily, what I'd like to go over is just essentially how the market works. Because just like anything, the financial markets are exactly the same as a produce market or any sort of retail market space where there are buyers and there are sellers. So essentially, we want to take a macro view and just kind of look at the economics behind the markets. So essentially, there are three different groups. Okay, the first group are the big money, and that's going to be your big banks. There's essentially 5 of them in the world. But everybody talks about the volume of Forex. $7 trillion a day is traded. Well, essentially, the 2 largest banks are JP Morgan Chase and Citibank, and between those two, they control 30% of the volume every day. So the second group, those are hedge funds and private private equity firms, that kind of stuff. And then the third group, that's us, retail. Okay, so what we have to understand is that we are not competing with anybody. Okay, the big money, they move the market, they decide where price goes. The hedge funds, they also follow the market the same way that we do. The only thing that's different is essentially, when we talk about stuff like stop hunts or, any of these other terms that seem like they're negatively directed towards retail. So since retail is such a small volume, the thing is that all of the retail traders are essentially placing orders at similar price. Whereas the big money, the big commercial banks, they're constantly moving money with transactions because the large banks have to facilitate all of the economies of the world. So if you have a large company that's based in the United States and they're doing business with a company that's based in Japan, and they anchor a deal together that's worth several $billion, well, that deal, in order for it to process, currency has to be exchanged from one to the other. And so those big banks are who are facilitating that. Now they're not going to take a commission on some sort of exchange like that. They're literally going to buy at one price and sell at the other. And so it's in their best interest that if they can push the price a couple ticks one way, that's how they're going to make money. And that's essentially the entire reason we have this foreign exchange market. So when we look at this monthly chart here, the same one that we looked at last time, so you can see that there are clusters where there is a lot of price action. So obviously the data only goes back as far as 2006, as far as Euro USD is concerned. But you can see price started off essentially where it is right now. And like we talked about before with our premium and discount, if we just take the high of the total range and the low of the total range, we'll kind of see how big of an expanse the market has moved. So essentially, we had this move up, and then for 5 months, we stayed in the same price. So what essentially happens in a move like this is you have people buying, 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 buying all the way up on this move. And then we get up here, and there's one of two things that are going to happen that are going to make price stall or make it reverse. And what that is all of these buy orders that were placed on the way up, once they start closing those positions, the opposite of a buy is a sell, right? If you have a buyer, you have to have a seller. So here, the sellers and the buyers reached equilibrium, which essentially means that they were equal. There was an equal amount of buyers and sellers at this price range. And so what that means is that there weren't people that were willing to buy as price continued to move up. And the people that were selling weren't doing so in volume that exceeded what the buy orders that were currently placed were. And so essentially with supply and demand, what we're going to call this is a rally and a move like this, where it's a period of consolidation, where price is stagnant. This is our base. And then we've got a move down, which we call our drop. So you have a rally, a base, and a drop. And that's going to be a reversal. The same thing, if you have it going down, you have a drop, you have a base, you have a rally up. Okay, there are continuation moves. So here we have a rally, we have a small base here, and another rally, which is a continuation. Same thing, drop, base, drop would be a continuation as well. So if we have an understanding that price wants to achieve equilibrium because there are buyers and sellers in the market, and every buy order has a sell order attached to it, we know that if you see this range here, there is equilibrium right here in the middle, and it's been tested several times. When price moves far away from it, it tends to act as a magnet and come back. And so for us, we had this pretty low pricing here, almost even 1-to-1 euro to a dollar in March, at the start of coronavirus. So if you want to consider the fundamental impact of a news event or lockdowns, pandemic, whatever influences price in something like that, we knew that as price was moving down, we have a strong base here that was very clearly going to get tested at some point, and then price moved away from it. So from a macro perspective, we can then determine that if the big banks control the majority of the money and they facilitate all of those transactions, the large money transactions, and hedge funds ride the trends along that just with more volume than retail, and then retailers are primarily scalping or trading intraday, or if they're swing trading, it's fairly short term in the grand scheme of things. Because I guarantee that from this price up here at the all-time high of $1.60, that the banks that put this move into action, that placed gigantic sell orders down here to push price down, they're still holding positions up here, because you can see as price came back up, they again sold again to form another drop. And then as price came back up, they sold again to drop the price. So all of the strong moves that you see, these strong impulses that we talk about, that we use to identify structure, that we use to identify areas of interest, they are made because the institutional money, the big commercial banks, the 5 major banks in the world, they're pushing price down. And it's not like they're sitting in front of a computer and saying, oh, well, the price is $1.60. we want to move price to $1.20. That's not how it works. What they're doing is the same thing that we're doing, just on a larger scale. They're placing gigantic orders. Because obviously they're always going to have cash reserves, and those reserves have to be held somewhere. You know, they're not going to just have trillions of dollars that are just stagnant. You know, they want to have it in the market. They want to have it in a place where they continue to grow it. So let's go ahead. We'll take this off and let's zoom in a little bit, and let's just kind of look and see what the market's telling us. So here's a good place right here. I'm going to throw on replay mode, and we're just going to take a look, because we have this gigantic move down on the monthly. Like this was massive. So let's go ahead and go in here. Let's drop down to an hour time frame. Oh, excuse me while I get this sorted out. All right, sorry about that. So we knew where we were. If only I could just get this to cooperate with me. All right. There we go. Yeah, so we're just going to go back and just kind of see how far we can go on 1 hour. So see what we get. All right, well, let's look at something more recent then, I guess. You know, I wanted to see one of these that just had a really massive impulsive move. Well, let's just go back. So obviously we've been in this huge bull trend for a while. I'd like to go as far back as we can before coronavirus, because obviously, like, you know, fundamentals are always going to push price more dynamically. I'm a big believer that fundamentals ultimately don't matter at all if you have a good understanding of technical analysis and supply and demand, and you know you can determine bias based on what's happening in the market. We are not predicting the future. We're merely reacting real time to what's happening and making educated guesses of where price may go. You know, I'm not saying like, oh, we've got this base up here, so they're going to sell from here. Let's go ahead and place orders up here, you know, when price is down low. Like, obviously that's not how we operate. We want to, you know, we want to just understand the reason why price moves, and then go from there. Learn how to acknowledge that information and then make our best educated guesses. All right, so you can see here we got a pretty strong downtrend, and so what we want to look at is just to see the reversal and kind of what price tells us. So as you can see, we had this strong impulsive move up. Obviously this is in H1, so this is over the course of a few days. It stalled a little bit here in the middle, which would be rally, base, rally. And what we can deduce from that is that when we look at where orders are going to be placed, right here at this reversal, this peak here, you know, somebody either exited out of the market from buys in high volume and in turn then put sell orders out into the market, or somebody came into the market with new money heavily selling. And so you see price moves up Here, it just stalls temporarily, and then price moves down. Then we see price retrace before it makes an even stronger impulse down. And so what we can assume is that from here at the very top, over the course of this base, that there's a big institution that's placing orders, but you can't just drop $1 trillion into the market, because if every order has to be matched with the opposite order, those orders need to be there to be filled. And so you introduce the orders um, steadily, but over a period of time. And so you have this up and down, because they've just got orders resting here. Just price comes up to take those orders, because when an institutional trader is looking at their screen, they're not looking at a chart here. They're just merely looking at the order flow and looking to see what orders are resting. So you're going to have some buy stop orders here. You're going to have some sell limit orders here, and then same thing. You're going to have some buy limit orders down here and some sell stop orders here. And so what they're doing is just bouncing up and down, just collecting the orders. And it's the bid and the ask, like what you see in the spread. And so if they're gonna fill orders at certain places, price has to go there. And that's this idea of this central bank algorithm that's driving price. What it's doing is evaluating where the orders are, and price is going to where those orders are. And all of these algorithms are executing, very quickly, especially with like the hedge funds. They've got these high frequency trading algorithms that are placing multiple orders every second. And so that's why you see this gyration up and down. When we talk specifically about price, we know that Forex has 5 digits, but a pip is the 4th digit. Institutional price only prices to the 4th digit. And so the difference in the bid and the ask spread from a broker is in that 5th digit. And so, if price is here 1554, the next order that's going to fill is 555 or 553. It's just going to go up and down. And so those tiny little tick moves are from the brokers trying to profit off of their minimal spread as price is moving through here. So anyway, so we see this base here, then we see a drop, returns back to the origin, and has another base, and then a strong impulsive move. So for a move like this to happen over the course of an hour, that's the introduction of a ton of money. So what most likely happens is that we've got big bank action here at this top base, then price moves down, comes back up because there's more bank orders that are just resting here waiting to be filled. Those orders get filled, but also you have the private equity firms, the hedge funds, all of the other medium-sized firms start jumping in to ride this new trend down. Come down, we have another base, and we have another drop. Okay, that's essentially the supply and demand, and that's the information that you should be able to get when you're just looking at the charts, is that we don't want to look at it as patterns or trend lines or zones or anything like that. It's always supply and demand. Okay. So if we're operating under the assumption that we had big commercial banks here, okay, that pushed price down, then they returned up and we had some more money enter the market to then drop it down, we would expect another return to origin here. And that's where, as retail traders that understand the way the order flow works, that's where we would then look to enter. So as you can see here, almost completely filled this inefficiency. And I'm sure on a higher time frame, on a 4-hour, that this was filled here. And so, like if we just look at it and we take this whole zone, right, from the top to the bottom, wick to wick, and again, we're just talking supply and demand. We're not going to be talking about orders or anything like that. So I'm taking this whole cluster. This is not technical analysis. This is merely just to explain this move. All right, sorry. My kids are home with me today and being extremely loud. So sorry if there's background noise. All right, so you see we have this whole cluster here, and then we have price return. So why didn't price just blow through this market, right? Why didn't it just hit this, take orders, drop back down, and shoot back up with all of this momentum, right? Because like we talked about before, if we look from this move down to this move here, so we've got 13 and a half days. And then from this impulse up, to the top here, we've got 6 days, half the amount of time. So momentum would tell us that it's to the upside, right? It's bullish. It's a bullish trend. Well, it's not exactly correct, because what we were talking about with market structure is that if we look over here, we created a new low. So we know that this impulse to this impulse up here, valid structure points that until price breaks up here, we're bearish. And so this would be a good place to start looking for sells, good zone, because we understand the supply and the demand aspect of it. And when we look at the structure of the market, that it's clearly in a downtrend here. Okay, let me clear this, and then let's go look for a buy example, just on the opposite end of the market. Okay, so you see right here, we've got this strong impulse down. Okay, and so, we can see that 6th, 7th, 8th. So this is a Thursday right here, this move down. And then we've got the 8th is Friday, and then the 10th, that would be the next week, Sunday. All right, so then we have this move down here, and then it starts to retrace up. And so if you look here, we got strong momentum to the downside. We're making lows. We have this slow retrace up. How many of you would look at this and look to enter there? Looks pretty juicy to me. And honestly, like, let's see here. I'm not seeing any notifications of people that are in the waiting room. Yeah, there's nobody. You can send the link or whatever. But yeah, I mean, people can join. This is going to be recorded. I'm more interested about just getting through the information for everybody that's on the call, and then if people want to join, they can. But it'll be posted just like the other one. So anyway, you see this period of consolidation, strong move down. I would be looking for continuation, obviously. And so why does something like this happen? We see it happen in the market all the time. Okay. So if we think about, where would your stop loss be if you were placing orders along the way? Not necessarily retail traders, just like, where would you be looking to exit the market if you're in a hedge fund, you're a commercial bank, you obviously don't want to have price go so far away if there's no, if we're introducing supply to move price down, when we hit demand, we want to move back up, right? Because once demand is filled, then we need to go and chase the supply. So where would all of these resting orders be? Well, they'd be here, over this price. So if you sold down into this, and then price is retracing, there's going to be a ton of limit orders here with stop losses right above. There's going to be buy stop orders that are above this. There's going to be buy stops up here. There's going to be sell stops up here, all of that stuff. And so as price goes through, obviously they were prime for this move. So they're just pumping money into the market so that we can just clear out all of these resting orders. Because when we look at supply and demand, we don't want to necessarily focus so much on where price is, but where price isn't. And so when you've got a big impulsive move down, we talk about inefficiency and pricing imbalance, all of that stuff. We know that this is going to get filled. But even, all of this, there's all this liquidity here resting above the price. And so as price moves back up, we see this strong impulsive move up. And so, you think about people hopping on the bandwagon, they're going to jump in with more orders here and keep buying. They see a strong impulse like this over 1 hour. So we clear this high, we have new market structures. So we now know that once this high is broken, it's bullish. Wait, why does price go back down? Well, if you look, we've got all of this void underneath here. Anywhere in here could be all of these stop orders or limit orders down here. And so price retraces, because if you're a bank and you're trying to accumulate positions, you're trying to buy up as many orders as possible, you're going to go. And so they're just buying all the way down here. We know we've got new structure. So all these people that are finally selling, they're taking the opposite buys all the way down. So why would they do that, right? Because if they pushed price up to get all these orders filled, they're holding buys here. And so at the top here, when we have this reversal, they're closing some of those buys, taking profit, and then buying more on the way down. Now, obviously, they're selling as well, and the hedge funds are selling. So we're getting this price continuation because ultimately price is doing this the whole way, bouncing up and down, because there's resting orders everywhere. And so that's why if you watch price live, you just see ticks up and down, up and down, up and down, because the bid and the ask price, there's going to be a little bit of a spread there. It's going to be, 1 pip each way. Just 1 second, guys. All right. Sorry, guys. We're going to try and blow through the rest of this because we've got some sibling rivalry happening right now. So anyway, these commercial banks, they're taking the other side. As people sell, they're just buying and just holding all of these positions, just going negative, because commercial banks, they don't trade with a stop loss. It's equity investment. So if they have $1 billion and it's then worth $990 million as price drops down, well, you know what? Once they hold those orders and push price back up by accumulating buys and moving price in the direction they want to go, well, as soon as it clears where those orders are, that $1 billion is going to turn into like 2 billion or 3 billion. And so for them, it's not about like handling drawdown, because all of this stuff over the course of however long this is, they're just holding positions. Okay. And so what I want to take a look at is we want to just take a look and see the COT data. So this comes from CFTC. But basically, this is the data that every Friday is released for the market ending on Tuesday close. And so it's commercials and non-commercials. So hedge funds, private equity that are non-commercial, and then the big banks, and just essentially what their positions are, what they're holding. So you can see that this is the last data that was available before this Friday. But you can see they're long on the dollar, they're short on everything else. Okay. The non-commercials, the hedge funds, they're short on the dollar, short on the Aussie, and long on everything else. So why would that be? Why would we have two different areas of money battling essentially? And that's the key to understanding the supply and the demand, is that it's not there's an excess of supply, so price is dropping. Everything is super short term. Hedge funds with high frequency trading algorithms, they're looking at ticks, versus like big commercial money is holding positions for a long time. And then the small little amount of retail money in the marketplace, combination, short term swing and day trading. And so when you have the big banks pushing price one way and then the hedge funds are taking the opposite side of the positions, that's exactly how it works because the market wants to achieve equilibrium. It's just like anything else. Um, so the metaphor for me, or the analogy for me that was really impactful when I was trying to gain understanding on supply and demand is just equate it to retail sales. If you think about um, any sort of commodity like corn, right? So the more flooded the market is with corn, the cheaper the price has to go because it has a shelf life. And so you can't just hold on to your corn for years and wait for price to rise for more people to enter the market with demand to buy up all your corn. You've got to liquidate that asset if it's not moving. Now, if you're the only farmer that has corn and everybody else's corn stock has just been depleted, like a bad growing season or something, well, price is going to rise because there's going to be more demand for the available supply. And it's the exact same thing when we're talking about financial markets because everything has an expiration date. Okay. So futures contracts are monthly, oil contracts, or sorry, futures contracts are quarterly, oil contracts, they're monthly. Um, when we're talking about the spot market, it's deriving prices from the futures market. Because right now, you can trade the Euro USD spot market, but you can also trade the current contract Euro futures. You can also trade the next contract. They've got contracts right now all the way through 2025, but they all have an expiration. If they're all quarterly, they're all going to trade and stop trading um, at the end of the contract. And so it's exactly the same thing when you look at retail. It's supply and demand. There's a certain amount of supply, there's a certain amount of demand, and wherever that balance is going to find, that's where price is going to go because it's going to achieve that equilibrium where people are going to buy and sell at the same price. Anybody who's on the chat, is this making sense? Cool. So when we're talking about the supply and the demand, there are going to be contracts that roll over to the next contract where they just hold their position, keep going. um and then also at the end of those contracts there's going to be a lot of closing positions, whether it's buy or sells. um because like oil, for example, when an oil contract ends, theoretically there's delivery of a real product. Obviously that traders that are all over the world aren't accepting delivery of oil barrels because they're able to dump that contract, they're able to offload it or roll it over to the next one. But there are times, like if you have a supply and there are no buyers, there is absolutely no demand, price just keeps falling. And that's what we saw earlier this year, where we had a negative price for oil. And the entire reason is because there were literally oil tankers just floating around in the sea with nowhere to go because there was no demand to accept the physical oil. So the contracts start trading negatively, where when you equate it, they are willing to pay money to offload the oil that they had because there was such limited demand. Um, it's crazy when you think about that, but that's the way the markets are. If there is no demand, the price will just fall. And if there's no supply and there's a ton of demand, price is going to skyrocket. Um, in macroeconomics, it's just the theory that resources are scarce. And that's the logic that we want to apply to the financial markets as well. Okay. Um, Again, everything that we're piecing together, it's all going to be rooted in logic. It's all, we want to be rational people. We want to um, be calm and collected as we're analyzing. We want to take all of the factors into consideration when we're making decisions. And so that's why we rely on logic and not on any sort of thing. Like if you're trading moving average crosses, like, oh, the 20 moving average crosses up above the 50, then we're changing to bullish direction. It doesn't make any sense because there is no narrative formed there. And so that's why, we started with market structure, we moved to supply and demand. Okay, so let's go ahead and just get really recent and just kind of take a look and apply what we have, um, and just see what price is telling us, see what the narrative is. So obviously we've been in this huge bull trend for a while. As you guys may know, depending on who you follow online or whatever, August through September, we had this little bit of a fake out. Just about everybody that I knew thought that we had a distribution forming, um, because price was so low at the beginning of 2020, just barely cents above $1, that price had been on this big push up. Everyone's saying, oh, we're in premium. And here's a distribution schematic that's forming that failed. And so as we actually look back at it retrospectively, we can see that it was reaccumulation, and that this is that type of manipulation with price trying to move up and down just to get better prices, to either close out of previous sell positions because price is moving up, um, or to accumulate additional buys for the big money. So obviously price keeps moving up. And as we looked at it on the higher time frame, on the monthly, like, it's very clearly that in the total range over the last 15 years, we're still in the discount. And there's going to be multiple factors, fundamental factors, that are going to apply there. One is obviously there's way more supply of physical liquid money than there was 15 years ago, especially in the US. They're just printing money nonstop. We also have some of the fundamental changes that have come about in Europe. Like, overall, the European economies aren't doing that great, and so that's why we see the narrative form and the technicals that support the overall narrative of just kind of where the global economy is right now. We over the last 15 years, we've had 2 recessions, and so it would make sense that we would still be in that discount area, but moving up. We do have this nice bullish trend, and what we've seen right now is we've started to see a little bit of this choppy price action that we can equate to the market cycle. So if we have this big higher time frame reaccumulation, obviously this accumulation of orders here is going to have to dump a little bit to pull back, accumulate more orders, and move back up. So obviously from a Wyckoff perspective, I'm looking at the market right now as a distribution forming, still within a bullish trend. And so when we start to see this right here, this is an increase in supply. Price is slowing down. We're forming a base here, and then we'll see, price, hopefully, if it all plays out, pull back a little bit. Obviously, like, when we start talking about entries, we're going to want to refine to the lowest time frame, to get those precision entries. But ultimately, like, if you just look at market structure and you look at supply and demand, you can overall make a pretty good assumption of what's happening in the market. If you see price slow down, it's accumulating orders, either buys or sells. Those are contracts getting filled. That's money exchanging hands. And then from there, it's just going to gain gain some steam to move. Like I said before, anywhere where there hasn't been price is gonna be a magnet. So if you look here, like we've got all this area under these relative equal lows, we've got all of this down here that remains to be filled. And so there's going to be resting orders there. There's going to be orders that didn't actually get filled the first time around. That price is going to come back and mitigate. Big money is going to accumulate additional orders to either move price up further or drive back down to collect more orders before then reversing. All right. Does anybody have any questions right now? Lauren, what are you saying there? So yeah, we'll go back to monthly and we'll see what we got. Yeah, but the thing is with the market structure and with momentum here on the monthly, like we're still bullish. We kind of, we tested those lows again and then move back up. Yeah, RBD is rally base drop. So rally base drop. Okay, drop base rally base drop. Just the terminology as far as supply and demand trading goes. Obviously, like, our zones that are going to be based on bullish candles are going to be demand zones. Our bearish zones from above are going to be our supply zones. Yeah, so basically, Lauren, if you're getting into the grand scheme of things of like the euro and the dollar, the franc, all versus some of the other economies, obviously, like, the reason that China isn't considered a major is beyond comprehension, because obviously their economy is just booming. I mean, it's been the fastest growing economy for a very long time. But ultimately, the US dollar was the last to come off the gold standard, and so is going to continue to be the base currency. And as far as the global economy is concerned, the US debt to other countries has a big piece to play in it. If you guys remember what happened in Greece in about 10 years ago in 2010, the economy was incredibly strong and the bottom just fell out, and it's just because of where those liabilities lay. And there's a lot more economically speaking that has an impact on financial markets than just these simple concepts. But for the everyday retail trader, I don't think any of us are trying to speculate what's going to happen over the next 10 years. I think we're at most very short-term traders, like looking over the next few months. My oldest position is like 6 months old that I've been holding. And that's very uncommon when you talk about trading, especially with the big money, because they'll just hold positions forever. You don't necessarily close positions, you just change your liability. So as you close out a position, it's so that you can accumulate many more. So anyway, as far as supply and demand goes, just to recap, we've got the three operators in the market. We have the big money, the big banks, JP Morgan Chase and Citibank, holding the majority of the liquidity in the market. We've got hedge funds, private equity firms, and then the third category is us, the little guys, the retail traders. If supply exceeds demand, we see price drop. If demand exceeds supply, we see price rise. The market seeks equilibrium because there has to be a buy order for every sell order and vice versa. And that's about it. You know, economically, we just we want to continue to see the markets as representations of their quantifiable real world applications of just the exchange of money to facilitate large transactions. So we'll leave it there. We'll post a video to recap, and just a reminder, like, nobody should be charging for any of this education or insight, anything like this. It's going to remain free. We're going to keep uploading the videos so that they'll be there permanently for people to review. And you know, just keep supporting each other, ask a ton of questions. There are many resources. We'll continue to share different resources, but ultimately just get on the charts, post the charts, ask questions. We're here to provide feedback. Okay, thanks guys.